This is Daybreak Asia. I'm David Ingles in Hong Kong.
And I'm Betty Liu here in New York. Well, let's get more on this Powell-led Fed raising rates as expected, steepening its rate hike path through 2020. David Kudla is the founder, CEO, and chief investment strategist at Mainstay Capital Management. Also joining us is Kathleen Hayes, of course, our global economics and policy editor, who's been watching the reaction here to the Fed. So, David, I know you were on your way here. I'm not sure how much you got to see of the Powell press conference, but what did you make of the statement today and his presser?
Well, we look at it as the statement today reaffirmed what we already know. We have a strong economy. And if we look at the Fed rate outlook for this year, for next year, whether we get 3 or 4 rate hikes this year, whether it's 2 or 3 next year, we know what the path is, and the path is higher.
Well, was it clearer to you? Because to others, I mean, we were interviewing Bob Eisenbeis earlier at the last hour. He found the statement and he found the comments from Powell quite unusual were his words. You know, you've got here expectation of 3 rate hikes, but the dot plots, right? For 2019 and 2020 just seem to not coordinate as much with some of the forecasts that were being put out.
Yeah, so we're seeing a little bit more dovish outlook for the remainder of this year, maybe a little bit more hawkish in 2019, 2020. What was interesting, too, was the statement about that stocks and real estate prices in some areas may be expensive, may be stretched. It goes back to when a Fed official talks about stocks, they rarely ever say they're undervalued. We had Janet Yellen speak about it back in 2014 with biotech stocks being stretched, overvalued, saw a big sell-off. So, we had originally a gain on the announcement of the Fed rate hike, and then with the president, we had then stocks sell off, the Dow losing more than 250 points with that gain.
Well, it's interesting to me, Dave, that the bonds rallied. They were a bit lower. They ended higher. And in fact, the dollar was weakening even before the press conference started. So I think that's one of the things that's kind of interesting about what the Fed has said it's going to do and what it's going to mean for markets. I guess you're saying, well, look, we don't care how much the Fed hikes rates as an equity investor, as long as the economy is getting stronger. I think maybe the bond market's saying, well, who knows? Maybe it was just repositioning, but it's just interesting. You'd think if it was that hawkish, you would have seen a sell-off in bonds.
Right. So that's where we think it was interpreted as being a little bit more dovish in the near future, meaning this year. So the dollar declined in value, a big decline that we've had in several weeks, and bond yields came back a little bit. But again, as long as the economy is strong, we think stocks do well. For bond investors, interest rate sensitive securities, we know what that path is, and you've got to avoid interest rate sensitive securities. Treasuries, high grade corporates, REITs.
David, I want to pull up a chart here, speaking about bonds and how treasuries have been pricing in, right, the number of hikes. #BTV 3894. At this point, what it looks like here is that the 2-year treasury on the shorter ends of the curve it seems, and particularly after the statement today, have fully priced in the Fed for this year so far. And that may mean that this flattening that we've seen so far might be coming to an end, perhaps, or slowing. What kind of impact, first of all, do you agree with that, and what kind of an impact might that have?
Well, we saw a steepening here, after the flattening we saw through last year, saw a little bit of a steepening. Now the curve flattening again, and certainly our concern there is, if we're looking down the road a long way, the inversion of a yield curve, the potential for that, when we're within 50, 60 basis points of flattening, we're getting close. But that could be quite a ways off. And what we see now along the curve, and we don't think a recession certainly is anywhere in sight.
David, this is David in Hong Kong. I guess to that point, though, nice name. All right, the 2-10 spread, that's at 57 basis points. So with this rate hike, I guess that squeezes down further short term before eventually and hopefully that eventually trends higher. What does it mean short term, though? I mean, because I've heard a lot of people say get into financials, but with that happening, maybe not yet. What do you think?
We like financials here. We are overweight financials this year because we see that net interest margin for the banks is going to improve. There are some other factors with a pro-regulation regime in government changing to deregulation or softening of some of the Dodd-Frank provisions. So we like the banks through here, and we think that across the board with what's happening with interest rates across the curve, it ends up being favorable for net interest margin.
So, David,
Now, based on...
Go ahead, David.
Go ahead, Kathleen.
No, you're the David.
Kathleen, go ahead.
All right. Oh, I was going to jump in and ask about the U.S. dollar and how much difference, if anything, that makes to someone who's invested in equities, because the dollar is been weaker. We've got the 10-year Treasury yield up around 2.8 and change, and it looks like it's kind of plateaued there now. How is that relationship going to play out? Is it going to depend at all on whether or not the Fed comes through with more rate hikes, or is it something else driving it now?
Well, we've been a dollar bear for quite a while now, and a lot of people have looked for a recovery in the dollar. We haven't seen it. Thought we were going to see it a little bit here in the near term until today. But when we look at what's going on with tariffs, when we look at what's happening with quantitative tightening versus easing around the world, we're seeing those rates come up. The other central banks were lagging the Fed, and so we think as the other central banks are in catch-up, are starting to raise rates, we think there's, it supports weakness in the dollar, and we see further weakness for the dollar ahead. For investors in your international, for U.S. investors in your international investments, don't hedge. We've been non-hedged on the dollar, so we end up with two contributions to our total return as U.S. investors. We have the return of the underlying securities and the currency in our favor, so that's helping our overseas investments do quite well.
So, David, based on these latest projections, we have 6 rate hikes, if I'm not mistaken, behind us already, 8 or 9 ahead. At some point along that trajectory, growth peaks. When do you think that's going to be, 2019?
I'm sorry, David, again?
So we have 6 rate hikes behind us, and we have likely 8 or 9 more ahead.
Right.
At some point, these rate hikes start to bite, and that lag closes. When do you think growth peaks in the U.S.?
That's a very good question. I think that right now, when we look at even the Fed raising their expectations for GDP growth from 2.5% to 2.7%, with what we've seen with our GDP growth here in the U.S., what we're seeing with global synchronized growth, lifting all boats and helping our exports here in the U.S. and really growth globally, we look forward to continued growth for, I want to say, 24 to 36 months before we think we're really into a problem. Now, what are the risks there? That we have a policy misstep, that the Fed hikes too fast, right? That's a concern. Or inflation, which, the other thing about all these rate hikes is what inflation are we fighting? PC at 1.5%, it's well below target. We just don't see inflation being that much of a concern either. So when we look forward through this year and into next year, we look for a continuing expanding economy here, not just here, but globally.
All right. David, appreciate you coming on the program, and what a stalwart you are getting through the snow. David Goodla, Mainstay Capital Management founder, and of course our global economics and policy editor Kathleen Hayes also there. Now just to pivot now to Facebook.